balance sheets. What are they and what do they mean? Hi, I'm Kimberly Shackrock, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. The balance sheet is a really important part of your company account, and that's because it tells you the position of your assets and your liabilities and how healthy your company is. So we're going to dive into a balance sheet today and really just talk it through so you've got a really good understanding of how it all fits together and what it means from someone who is looking at your company accounts and how healthy it says your company is. So let's dive into an example balance sheet so that you can see exactly what to look out for when you are looking at yours and how you can make yours stronger so that you can make your business an attractive business to be selling in the future. Let's check out some balance sheets then and see what we can see. We're going to look at two examples and you'll probably see in a moment as we go through them the reason for choosing two. Let's dive into example company limited, our first example, and as you'll be able to see on screen, we've got our balance sheet on screen. So let's work our way down and see what is involved in it so you can get an understanding of the statement of financial position or balance sheet, as are the two names that you'll tend to come across them as. You'll always notice on a balance sheet or statement of financial position that you've got the company name and the registered number at the top, and normally the year end that is being looked at. So for this one, it's the 31st of March 2024. But it doesn't really matter what year we're looking at because the principles of looking at the balance sheet are going to be the same whatever year you are looking at. Now, apart from in the first year of your balance sheet, you are always going to have 2 years. You're going to have your current year and you're going to have your comparative year. The formatting that we see here today is a standard format that you will tend to see all balance sheets in. There are potentially a few additional lines, which we'll see a couple of different ones on our second example, but all of these are pre-formatted under standard accounting standards. So this is what they have to look like. So starting at the top, we've got our fixed assets, which covers our tangible assets if there was any intangible assets. So these are physical things like computers, furniture, that sort of thing for tangible assets. Or for intangible assets, these are things that are not physically present. So things like your website, if you're capitalizing it, or patents or goodwill or different things which are not real, you can't touch them, is how I tend to term it for tangible. But they are assets of the business that are going to help generate future income for the business. We've then also got here our investment property, which for our property investors out there trying to understand their balance sheet, this is one of the important ones. Now here we can see we've got these lines, and this tells us in effect the value of those assets as at the balance sheet date. So these may go up, they may go down, but this is just at this specific point in time. Notes 5 and 6 I've not got today because we're just focusing on this one page of the financial statements. However, those notes will show more of a split and some of the movements. If you're interested in finding out more about the notes, then do leave a comment and we can do a specific video explaining how those notes fit together. We then move down on our balance sheet to our current assets, and our current assets will include things like our debtors, prepayments and accrued income, and our cash at bank or in hand. Debtors are the money that is owed back to the company from somewhere else. So in this example, it may be intercompany transactions that it's loaned money to another company, so it's expecting that money. It may be there are tenants that haven't paid their rent and you've got money that is owed back to you. Other examples may be you've got deposits. So this could be the deposits you've received and the deposits that you've had to pay out, which would show as a debtor and a creditor in your accounts to show that there's money that you've received that you owe back to them and money you paid out that you owe back to the company. So there's a few different things which may fall into the debtors category, but this is the positive numbers. These are the things that are things owed to the company, and the higher the number the better because that's money owed back to the company. However,
You don't want the number too high because that means that there's still a lot of money that you've got to chase into the company, which may also be seen as a negative. So there are pros and cons to debtors because it's a positive, it's showing assets, it's showing positive position for the company. However, we don't want that figure to be too high, because if this figure is too high, it means we've not got good management of the people who owe us money, which is not a positive thing. Our next line is our prepayments and accrued income. So this is going to be things like your insurance, where you paid for your insurance for 12 months, but part of that 12 months is in next year. So this is some of that expense which is being pushed forward into the next year. So this is an asset because this is something that next year you'll expend that expense and probably incur more expenses, which you will then push forward into a future year. So this is very much an accounting adjustment line, rather than any physical or practical application that you can do with that number in the future. Now, cash at bank and in hand, as we can see in this example, last year there was a lot of cash in the bank. This year there's not so much cash in the bank, potentially because they may have paid investors back, they may have paid off something towards any mortgages that they hold. This balance ultimately is very important because you don't want a company to have a negative cash balance, because that means that they're overdrawn. But then again, you don't want to see that they've got lots of money sitting on one side doing an awful lot of nothing. However, obviously a cash-rich company is a positive, because if you're going for lending or if you're looking at other things, then potentially it will seem that the company can afford to pay its debts off. So there are reasons why you may want that to be as positive as possible, or not too positive, because you don't want to be holding cash in the company when there's no particular use for it. Now, this is where we shift from being in the positive, the asset side of things, down to the creditor side of things. And our creditors are where we owe money to people. So we've got our amounts falling due within 1 year, which may be our mortgages that are owed within 1 year. It may be our loans that are owed within 1 year. It may be investor loans that are owed within 1 year. So on this one, they've got quite a sizable chunk of money, from 800 last year to 700 odd K this year. That is going down. So if you're looking at the balance sheet from a positive point of view, it is saying that they are paying off their debts over time. Now we then have our net current liabilities, which is simply a calculation between our current assets, take away our creditors, which gives us this net current liabilities or net current assets. It will be a net current assets if it's a positive figure. It will be a net current liabilities if it is a negative figure. So as we can see here, they have got a negative figure, so that is going to be deducting things. We then have our total assets less current liabilities line, and this is taking then our fixed assets line, taking off that net current liabilities we've just calculated, to give us what our total assets less current liabilities are, before we are now bringing in our amounts falling due after more than 1 year. And this amount is going to be your longer term investors, your longer term mortgages, which tend to be your mortgages, potentially not bridging, because bridging tends to be a year. We tend to see that in our amounts falling due within 1 year. And then it's potentially our private investors, our angel investors, our third party investors, where you might have longer agreements where it would fall within our amounts falling due after more than 1 year, or if they're just short term contracts or ongoing contracts with 6-month renewal repayment periods or notice periods, those ones would fall into your amounts falling due within 1 year, because they can always give 6 months notice. So depending on the position of those loans will determine whether it's in that further line up in our amounts falling due within 1 year, or lower down as our amounts falling due after more than 1 year. In this case, that figure's remained relatively consistent, which is probably not surprising, because a lot of investors do tend to go around the interest-only mortgages, and if it's an interest-only mortgage, the actual mortgage themselves is going to remain relatively consistent. So on that basis, from that point of view, we have got 2 of them that are sitting there. Now, our next line is our accruals and deferred income. So this will be things like when the accounts come around, you have your accountancy fee, the accounts will tend to accrue the accountancy fee. It could also be deferred income where you've received rent on the last day of the month, but it's for next year. So that will be deferred and pushed into next year. So this will vary based on what is happening at the specific time on that date, as we're always doing things on our statement of financial position or balance sheet to the specific date. So tomorrow the position will have completely changed potentially as invoices are issued to you, or you may repay investors or do different things. So we've now got our total assets less current liabilities. We'll take off those creditors falling due after more than 1 year, and we'll take off those accruals. So for this business, we are in a negative position. We've got a negative 133k compared to 108k in the previous year. So does that look good? Well, I suppose the answer is no, it doesn't look good. Anything in a negative position is not good. The other negative point to mention here is the position is getting worse, which means they're spending more money and they're not recouping the money that's been spent. So the position's getting worse, and at some point, will they actually be able to pay everybody back? Will they be able to clear their mortgages? So this is a company that needs some monitoring, needs to be managed, so hopefully it can be moved into a better position in the future. Now, the other side of our balance sheet, where we're actually balancing things through, comes down to our capital and reserve section. So our capital and reserve section is where we have our share capital. So in this case, we've got 10 shares. This will be whatever shareholdings you have. It shouldn't change from 1 year to the next because you're not going to be doing lots of share changes, which means it could be 1, it could be 10, it could be 100, whatever you set the company up with. We've then got our reserves, and we have 2 specific reserves that we need to consider. One being our fair value reserve and one being our retained earnings. Now, our retained earnings is basically the profit or loss that we've made in each year. So if we think each year we make a profit or we make a loss, that goes into a pot. If we then spend that money, or if we take that money out as dividends, should I say, that money will reduce the reserves figure because we can only take dividends out of these specific profits, these retained earnings. So at present, we can see in this one, we've got a negative 144 moving to a negative 191. So as we've seen, the position is getting worse. They're losing money and money is not being recouped. The other reserve we've got is our fair value reserve, and check out the videos on the fair value reserve because there is specific area covering how this fits together if you just want to understand what your accountant's doing for you, so you've got a good grasp of how it fits together even if you don't want to actually be doing any of this. Now the fair value reserve, to just do a summary here, is basically the difference between what you've spent on the property that you're doing, all those cost improvements, and what is actually realistically worth today. And this value will be put here as a fair value reserve because it's not actually realised. And what I mean by realised is you've not sold that property and got that money back yet. What has happened is you've got the value of the property in the company now, so you may have spent 200,000, it's now worth 225,000. We've got a gain of 25,000, but it's not actually been sold, so you've not physically made that gain yet. But it is still an additional value in the company that we want to take account of. So that means what we'll do is we'll increase the value of your investment property, but we'll need to put in this fair value reserve to hold it there until you do actually realise that you do actually sell the property and get the profit that has been made on that property. So as we can see in this company, the value has been increasing. So they have increased the value of the properties and there is some positivity here. However, that figure is not yet outstripping the losses that they've obviously been making in this company for their retained earnings. The figure at the bottom is the total of the 3 numbers in the capital and reserve section, and that should always agree to your net liabilities or net assets position above. That's where the balance sheet comes in, because you're balancing one side, the assets and liabilities, with your capital and reserve side, and those 2 figures should equal each other. There's been the odd balance sheet I know I've seen that doesn't balance, but hopefully yours all balances, and with the help of your accountant, that is made sure that everything fits together. Now, at the bottom of your balance sheet, there will always be some specific disclosures, and these are all required by law to just state the different bits, such as where you've used exemptions from audit, which 9 out of 10 or 99 out of 100 of you will be using. It also has said that we are not required to do an audit under the Companies Act, and that you as a director have acknowledged your responsibility for keeping records, preparing financial statements. This is just telling us all the different bits under the specific Companies Act that we are making sure have been done. We've then just stated the financial statements have been prepared in accordance with the provisions applicable to companies subject to the small companies regime. Because this one is the small companies regime, it may be you do your accounts under the micro company regime, and it just needs to be stated from that point of view. Then we've got the approval by the board of directors on whatever date, and then it is signed off by the individual. So as you can see, there is a few different disclosures at the bottom, which are just the statutory bits. And then we've got all our numbers at the top, which give us an idea of what the assets position, what the positive position, what the creditors, what is owed to someone else, to give us the final position. Being insolvent has its own consequences. So there is certain things about if you are insolvent you just need to be aware of, but check out the separate video on having an insolvent company so that you've just got an idea of what the implications may be. Let us therefore move on to our second company and get an idea of a more positive position. Let us move to Property Company Limited again, with, as we can see at the top, we've got our registered number and our statement of financial position or balance sheet position. We've got a different year end here because we're going with the 30th of June 2024, and because it's not the first year, we have got the two comparative columns. As you will hopefully see, in this example, we have exactly the same sort of headings. There's not too many that you can see here that are particularly different to what we were seeing before. So in this example, we have got some tangible assets, we have got some investment property, and this is showing as a positive position as the company seems to have been buying some more assets in 2024, whether it be computer, furniture or something like that. Investment property has gone up, so that to me would either suggest we've got some really good uplift in value, or we have got some property purchases in that period. Now, a new one that we didn't mention in our other one is the interesting point of our current assets, and we've got stocks in this one. And the reason we'll have stocks in this company is because they're probably doing some sort of flip. So if we're doing a flip or we're developing a property, that is arguably not an investment property. That is a trading property that you're going to be buying and selling. So that falls in the remit of it being stock rather than investment property. So on this one, we've got a stock item, which is a property that's being done up to sell in the future. And because we're doing a balance sheet, we're always looking at this specific date, which means if we're looking at this specific date, at this point in time, the property was still being refurbished, or it may be complete, but it hasn't been sold yet. So on that basis, we have got it sitting here in stock, whereas last year we didn't have any stock. We've got debtors, we've got prepayments, which are again smaller numbers, which it's possibly a negative that the debtors is less than last year. However, it's possibly a positive because it means we are on top of collecting our debts. So there's kind of mixed messages to that, and it depends on the company and what you know about it, which may explain any changes in these numbers. Prepayments and accrued income, again, we can see they're small numbers. It's probably insurance or something along those lines. And we've again now got cash at the bank and in hand, which is significantly decreased from 231k down to 12k. However, on this example, I would highlight we've had investment property go from 475 to 701. So that would suggest that that money has probably been used to purchase a further property. So as you can see, we're just piecing some of the puzzles together here to get an idea of your balance sheet and what has likely happened. Now, you will know the ins and outs of your own balance sheet, hopefully, because you'll know what movements and what things have been happening. However, if you are looking at someone else's balance sheet, it may give you insights into what could have happened, what may have happened, which is really great if you're thinking of buying another company, to know what questions you need to be asking to get an understanding of how the business is operating. Now, creditors here within 1 year, that one for this company is remaining relatively similar. So this again, as we said, is likely to be potentially other investors, maybe intercompany loans, maybe mortgages that are due within 1 year, bridging loans, that sort of thing. The difference we have on this one is our total assets less our current liabilities is giving us a positive figure. We've got 511k compared to 352k. So they're in a much more positive position than they were in the previous year. Now, if we keep going down, we can see our creditors' amounts falling due after more than 1 year is greater from 364 compared to 275. So that might suggest we've got some sort of loan or mortgage on that new property that we appear to have purchased, or we've maybe refinanced something and the value of that investment that we had has gone up noticeably based on the other figures we're seeing. Now, one new one that we've got on this balance sheet is our provisions for liabilities. And this tends to be on the property companies for most of them, is going to be our deferred tax provision. And deferred tax, check out the channel for what deferred tax is in detail. There's a whole video going through this fake or imaginary tax. But this is where it will appear, this imaginary tax, to show as a provision that in the future, if you sold everything, this is how much tax you may have to pay. So on that basis, this is coming off here to take account of future possible taxes that you may have to pay. And then we've got just our accruals and deferred income, which is just a small balance on this one. And on this basis, we have got net assets, which are sitting at 108,000 compared to 56,000. So this is a company that is positive, it's in a good position, it is not insolvent because it is positive, it has got a positive figure rather than a negative figure. So this looks healthy, this is looking good, and some of the figures further up are showing that this is a growing, expanding property business. Now we can move down to our capital and reserves, and this one we've just got the one share capital, £1, and we've got our fair value reserve and our retained earnings again. Now on this one, both are positive, which is great because that means in our retained earnings there is the availability to vote some dividends now. If this figure was negative, we could not vote any dividends. So it's just an area to be aware of, because you may think, oh, my reserves are positive, but if all your reserves are positive because of your fair value reserve, which is basically the increase in value of the properties rather than an actual profit in the company, you can't take those fair value reserves as dividends. It is only the retained earnings figure that you can take as dividends. So as we can see, the fair value reserve has gone up because some of the properties have gone up in value, and the retained earnings has gone up. So that would suggest that the company is making a profit in the year. Now we've also got all of our normal disclosures which follow underneath, as we had on our other example. So if we were to compare the two, we've got our one company before that was insolvent, that was obviously having some financial issues, and then we've got this one that is showing a positive growth. It doesn't look like they're making a lot of profit based on the fact that the retained earnings have not gone up too much, but that may be because they're taking all of that money out as dividends, which is reducing the reserves back down to where they're sitting. But it is positive, which is giving you good indication that the company is going to be able to continue into the future, is a good risk, is a good company, and is worthwhile investing in if you were thinking of investing. Or the other side of things is, you know that you've got a good company to be going out there and get mortgages, getting loans, getting private investors from that point of view. If you have any specific questions on the balance sheet, then please do leave a comment, and we can go into any detail on any specific areas that you might find interesting, just to make sure you understand what is happening in your company and how it is all fitting together.
As you can see, there's quite a lot to be aware of on your balance sheet, but hopefully that's given you a bit of a taster of what the different things on your balance sheet are, so you can get a good understanding of how it fits together and what you need to be looking for, especially if you are at the point of looking at selling your business, so that you can make it as strong as possible to get the best possible price for your company.
Hopefully today you've discovered what is on your balance sheet, how it fits together, and what it really means for your business. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing.